Energy markets are currently on edge, with governments across Europe and Asia holding emergency meetings to brace for a disruption. Much of this anxiety centers on the Strait of Hormuz, a narrow passage that serves as the only sea route from the Persian Gulf to the open ocean. Roughly 20% of the world's oil passes through this single point every day. The common assumption among analysts is clear. If this passage closes, the global economy faces total collapse. But that story only accounts for half the reality. Oil shocks have never hit every nation with equal force, and today, the geography of energy has created a distinct gap between those who lose and those who gain. Fears of a crisis often rely on a 20-year-old model of the world. 2 decades ago, the United States was a major importer, bringing in 60% of its petroleum. Back then, instability in the Middle East led to immediate spikes at the pump and a direct freeze on the American economy. That version of the world is gone. Today, an energy disruption at the Strait functions less as a threat to the US and more as a geopolitical weapon pointed at its rivals. Reacting to today's market with an economic playbook from 20 years ago misses the massive shift in how global power is actually exerted. Over the last 2 decades, new drilling techniques unlocked massive shale reserves across the United States. This boom didn't just reduce reliance on foreign fuel, it reversed the flow entirely. The United States is now the world's largest producer of both oil and liquefied natural gas. This production surge shifted the exposure math at the Strait of Hormuz. Only 2.5% of the oil moving through the passage is destined for the US. The vast majority, 75%, is headed to Asia, specifically to China, India, Japan, and South Korea. Since oil is priced on a global market, a disruption still raises costs for American consumers. But while higher prices create friction, they are a manageable price problem for a country that is also the world's top producer. In fact, when global supply tightens, it generates a massive windfall for American energy firms. We've already seen companies like Venture Global and Cheniere Energy see their stocks climb as they step in to fill the gaps in the global market. For the US, a Middle Eastern crisis provides a paradoxical boost, strengthening its trade position while other regions struggle to keep the lights on. China faces a much more dangerous reality. While the US manages a price spike, China faces a physical blockade. China imports roughly 11 million barrels of oil every day, and a massive portion of that must pass through the Strait of Hormuz to reach their refineries. A supply choke has immediate structural consequences. Without physical fuel, factories slow down, energy is rationed, and the manufacturing core of their economy begins to stall. China has spent years trying to hedge this risk by diversifying with suppliers in Russia and Brazil and building up strategic reserves to buy themselves time. These safeguards only delay the inevitable. Based on China's massive daily burn rate, strategic reserves can only sustain their industrial output for a limited window before the lack of Hormuz access becomes an existential crisis. China's industrial model depends on this constant flow. Manufacturing and exports are hardwired to these shipments, meaning any prolonged blockage threatens the country's very stability. The timing of these tensions is notable. Escalations in the Middle East have repeatedly flared up exactly as the US and China reached critical points in negotiations over tariffs, technology bans, and supply chain decoupling. Leverage and high-stakes diplomacy comes from the ability to tolerate a shock that your opponent cannot. Right now, the US is recording record profits from its energy exports, while China is forced to draw down its limited reserves to keep its factories running. That gap in pressure is a powerful tool at the negotiating table. When one side gains revenue from a crisis, while the other faces a structural breakdown, the instability itself becomes a form of economic coercion, a way to force concessions without firing a single shot. The Strait of Hormuz is no longer a simple bottleneck for oil shipments. Today, it is a valve that can be locked to exert pressure on the world's second-largest economy. In this new era of energy independence, the Strait has become the ultimate choke point for global power, quietly securing American leverage in a divided world.